All right, I've got 1 p.m. Central Time out here in beautiful, snowy Omaha, Nebraska. I'm so pleased to have Spencer Rolfe with me today. Spencer, thanks for joining us on this week's call. I'm really excited and curious to see where this one goes. So thanks for joining us and making the time.
You bet, John. I appreciate the invitation. Happy to be here.
Yeah, well, we chose an interesting day to have our call as usual. Man, we live in interesting times. So, a relatively aggressive CPI print today caused the bond market to go up. The 10-year crept up a little bit. The S&P and Dow didn't really like it. Man, some of these market trends we're seeing, interest rates, tariffs, political regimes, starting to create a little bit of havoc on investments. What's your guys' investment approach in these current market trends? How are you adjusting to all these new variables being thrown at us?
Well, John, I think the first thing that I'd tell you is that when we think about our overall investment philosophy, we're bottom up fundamental value investors. So we're focused first and foremost on the underlying fundamentals of the businesses and the assets that we're investing in. So we're focused on free cash flow, asset value, and margin of safety. And in markets like today, where there's lots of uncertainty, whether it's rates or tariffs, as you mentioned, and particularly in the bond market, credit spreads are at near all-time tights. And so, how we think about mitigating these challenges is not by trying to devise a top-down approach to our portfolio management and underwriting process, but thinking more about idiosyncratic and company-specific events to underpin our investment. So whether that's event-driven investing around corporate actions or staying short durations, particularly with credit investments, staying short duration can help mitigate some of that interest rate sensitivity. And so a combination of that approach should hopefully allow our investment process to be relatively insulated from the uncertainty and some volatility that we see in the market related to whatever rates are doing or the political regime happens to be doing at any given time.
Yeah, well, I'm going to say this a little bit tongue in cheek, so please humor me with it. But who wants to talk value investing when tech stocks and AI stocks are delivering 30% returns today? It seems like it's the bond market, value investing. Where's there a place to go? So from a thematic perspective, when you think about corporate credit, taking advantage of these super tight spreads, even equities, what are some themes to even think about that can kind of be can compete with the tech AI enthusiasm we've been seeing?
Well, we have no problem with being boring
Hmm.
relative to what you may see going on in the headlines. You mentioned these high flying tech stocks and AI investments. Well, as you saw just 2 Mondays ago, just one wrong headline about DeepSeek can send those things down 20-30%, and everyone's scrambling to try to figure out, well, what exactly does this mean? What exactly is going to happen here? So we're happy to be finding opportunities that are relatively, I think, boring or process driven in comparison to that. And look, we're trying to find opportunities with high current income and opportunities for capital appreciation. And as I mentioned, we are leaning into corporate events. One such category that I think we're relatively constructive on is seeing merger and acquisition activity pick up over the next 12 months, particularly with the new administration coming in. We've got a new FTC, we've got a new FCC. I think one of the themes that overshadowed the M&A market over the prior 2, 3, 4 years was a relatively conservative FTC. You saw Spirit Air had their merger blocked. That company ended up going into bankruptcy. So I think that we'll see corporates face a new breath of fresh air with result to M&A. And so within that, and particularly when we think about corporate credit, quite often bonds and loans have features in their underlying documentation called change of control covenants. And what this means is that when those businesses are acquired, that bond, for example, needs to be taken out quite often at a 101 change of control premium. So we're currently seeing opportunities in relatively safe credits, in our opinion, with good cash flows, good asset values that might not be trading at yields that are exciting on a standalone basis. It might be something like a market yield, but if it's a long-term bond with a low coupon, then the price of that bond might be at an interesting discount to par, call it 92 cents or 93 cents. And if we think that these are businesses that make attractive acquisition candidates, whether it's from a strategic or a financial sponsor, and you could do an LBO on it, then you can close that gap on the bond price relatively quickly and increase your rate of return that way. So one, we like I think we like building products and building distributors in the space. Right now, we've seen some increased M&A activity in that area, and I think we'll probably see a little bit more of that going forward.
One thing I think that comes to my mind, at least when you talk about M&A and corporate events, is the cost of capital, especially borrowing capital. Are some of these deals predicated only on changes in FTC in a more favorable environment? Are they predicated on changes in interest rate environment? Do we need rates to come down for them to occur? Or do you think it's just growth minded coming out of the last administration, or even forward looking, that things look pretty rosy for these companies to go ahead and take advantage of these corporate events?
Well, I think one thing that we need to be careful about is we need to be careful that we are not making investments where maybe the underlying thesis or driver is actually tied to lower interest rates. For example, so within real estate, for example, we're making sure that we're mindful of not getting involved in situations that are very sensitive to needing interest rates to come down. As I mentioned, we have no crystal ball. We don't have a particular view of when or if interest rates will come down. But if you have an asset that generates that's a 6% cap rate, that asset for an equity investor, that might only work if you can get attractive financing in a 2 to 3% interest rate world. That type of an asset, particularly if there might be fundamental problems in the asset. If it's office, for example, because office, now you also have to worry about occupancy rates and work from home and return to office trends, which may or may not be going in your way. But that can all influence the value of that asset. And so if you're in a higher for longer interest rate environment of 4.5% base rates, then you could easily find the cost of financing for an asset like that exceed the cap rate that it actually generates. And so then that asset becomes very difficult to finance, either to refinance out existing debt or to purchase. So we're trying to stay mindful and keep away from assets that have characteristics such as that. Which really, at the end of the day, if it's that interest rate sensitive, that's out of our hands. That's out of the company's hands, and that's not very interesting to us.
Oh, that makes sense. I want to stay on this real estate hit a little bit here. We love real estate. There's always pockets of inefficiency because it's so big and vast. But on the residential side, we're looking at the 30-year back up above 7% again this week after dipping down before. The place I go shows about 7.13% in the 30-year. What part of real estate is interesting for you guys at this time? You mentioned some big picture stuff. Narrow it down a little bit. Are there any subsectors that you like that are more interesting than others?
Sure. I think I'll give you two examples. So one within real estate is I think we're very interested in pockets of retail real estate that are showing signs of strength. So whether these are mall operators or outlet center operators, these are businesses and assets that we're finding that despite challenges to the consumer are still generating positive free cash flow, are growing their net operating income, and are deleveraging their balance sheets. So we like, for example, we like an operator on of a post bankruptcy, post reorganization issuer that had delevered its balance sheet after filing bankruptcy during COVID, and has now come out of bankruptcy, as I mentioned, with a cleaned up balance sheet, and has a loan that's secured by a portfolio of regional malls and outlet shopping centers that has all those characteristics that I just mentioned. It's generating positive NOI and free cash flow. The underlying cap rates are attractive on assets like that, where we think that there's sufficient margin of safety to get our money back, either by selling assets or by delevering organically by paying down debt with free cash flow, because as I mentioned, those assets are free cash flow generative. That's one area where we've been finding opportunity. Another area of opportunity that had been interesting for us is you had mentioned with respect to residential mortgage rates staying high. There's been a lot of collateral damage from that, and we've been finding opportunities in stressed and distressed debt from issuers that had been tangentially impacted by that dynamic. So one example is we purchased the discounted bonds of a software and residential home insurance provider in the space that, while being a perfectly fine originator, had problems due to those dynamics where you had just mentioned. And this was a business that has cash, has liquidity and runway, and also is undergoing a very comprehensive internal business reorganization to shed some of those more capital intensive and I should also mention liability intensive parts of its business, and becoming more of an asset-light originator of insurance policies. And we think that in a situation like that, you see accretion to your margins and free cash flow generation, coupled with a bunch of cash and runway. We would expect the debt of that company to perform better, that credit improve, and return from more of a distressed issuer to a performing credit, and refinance a relatively short-term balance sheet. And we think that's an interesting opportunity for total return.
Yeah. Well, those are two interesting ones. Let's stay in that kind of sector really quick before we wrap up. And, it seems like with the tech and AI revolution, hard assets in some respects are starting to get attention, whether it's, data centers, whether it's pipelines to provide the energy that these chips need and such like that. There's all sorts of nuance with that. But are there any particular sectors of hard assets that you guys are finding attractive right now, energy or otherwise?
There are. One area that I think I can highlight for you is within commodities. I think that we find iron ore to be relatively interesting as a commodity. And whether it's from increased demand for power as a result of growing need for AI bandwidth and power solutions, whether that can have impacts on raising demand and commodity prices as a result of that, or also, as we mentioned at the beginning of this call, tariffs are having an impact on commodity prices around the world, and you might find uplift in that area. But I would tell you that regardless of what's going on in short-term trading of commodity prices, we find low-cost, high per-ton producers of commodities to be interesting investments when you can buy them cheaply enough, because these are the assets that survive when commodity prices undoubtedly downturn. And we have no ability to predict what commodity prices are going to do, but that tends to be an opportunity where high cost producers are shaken out of the industry because they can't economically compete, and you have market share start to shift around. We think that's interesting for those reasons, but also because you do have the underlying assets. In this case, we like iron ore mines. You have the underlying mines. There's a present value to the value of the cash flow that you can extract from that mine over the life of its reserves, and that's something that you can sensitize, and you can often buy it at attractive prices relative to its present value from time to time. And so within the space of real assets, I think we find that to be a particularly compelling space right now.
Yeah, those are great ideas. Well, Spencer, awesome. We're right at 15 minutes where we like to end. This has been a wonderful call. Appreciate all those insights. I love the idea of living in chaotic and interesting times, which we do. For all those participating, thank you so much for your time today. You'll see on the screen a quick poll, ways to learn more. Again, we always have this call on the second Wednesday of every month. If you'd like to receive additional information, please go ahead and fill it out there. Call with one of your local representatives, me or Spencer. We're happy to kind of answer additional questions for you as well. But thanks everybody for joining us, especially Spencer. Thanks for making the time today. Look forward to next month's call, and let's keep up these interesting insights and ideas. Thanks so much, my friend.
Thanks, John. Appreciate it.
All right. Thank you,
Have a
everybody.
nice
Have a
day.
wonderful day. Take
Bye.
care.